Have you noticed how silence is always the last sound before something breaks? No alarms, no sirens, just numbers quietly hitting zero. What if I told you the housing market didn't slow down, didn't cool off, didn't normalize? It froze, completely. Not yesterday, not someday, now. This morning, data was released that Wall Street hoped would stay buried. Existing home sales collapsed to levels not seen since 1995. But that headline alone hides something far more disturbing. In several major cities, sales didn't just fall, they stopped. Absolute zero. No movement, no transactions, no buyers, no sellers. That isn't a slowdown, that's cardiac arrest. For weeks in a row, entire metropolitan areas saw not a single home change hands. Think about that. Families didn't upgrade. Seniors didn't downsize. No relocations, no fresh starts. The market wasn't breathing. And when the average American can no longer afford the average American home, the system doesn't bend, it snaps. What you're witnessing right now is not a future risk. It's the beginning of a mechanical failure already in progress. And what's unfolding behind the scenes, in commercial real estate and regional banks, will decide whether wealth is protected or erased. Now I know what you're thinking. This all sounds dramatic, overstated, maybe even boring. And that's exactly the point. We call this the boring economy because there's no hype here. No carnival barkers promising fast money. No financial influencers screaming shortcuts, just raw arithmetic. The kind of intelligence real operators use when everything is on the line. If you've been around long enough to remember real economic cycles, if fairy tales don't work on you anymore, then stay with me. Because what you're about to hear is the difference between positioning early and being crushed quietly. The numbers arrived on a Tuesday morning and confirmed what economists had been whispering behind closed doors for months. The American housing market didn't just slow, it locked up. The National Association of Realtors released their latest report showing used home sales plunging to depths last seen 3 decades ago. 30 years of growth wiped out on paper. But surface data only tells half the story. When analysts drilled down into regional figures, they found something chilling. Entire cities where sales didn't decline, they vanished. 0 transactions for weeks. Total paralysis. This wasn't fear. This wasn't hesitation. This was math asserting itself. 3 years ago, in 2021, the average family could finance a home with a monthly payment around $2,000. Same house today, same walls, same roof. $4,000 a month. The payment doubled. Incomes didn't. Wages moved maybe 5%, 10% if you were lucky. Housing costs doubled. That's not economics. That's arithmetic failure. Analysts ran the numbers and reached an unavoidable conclusion. Nearly 80% of potential buyers were mathematically eliminated. Not unwilling, unable. So, who is actually buying homes right now? The data exposes an uncomfortable shift. Cash-rich institutions, corporate landlords, foreign capital parking money in American soil, investors who don't need mortgages, approvals, or wages. Meanwhile, the average American family, the people who live and work in these neighborhoods, have been priced out of the country they sustain. This creates what economists call a structural imbalance. When the median household cannot afford the median home, the market must correct. That's not ideology. That's math. The only unanswered questions are when the correction hits and how violent it becomes. Interest rates poured gasoline on the fire. For over a decade, the Federal Reserve held rates near zero. Money was cheap, credit flowed freely. Home prices inflated quietly, then aggressively. When inflation arrived, the Fed had no choice. Rates were raised at the fastest pace in over 40 years. Mortgages that once sat below 3% surged to 7%, even 8% in some areas. Each single percentage point added hundreds of dollars to monthly payments. But rates weren't the only cost exploding beneath the surface. Insurance companies began pulling out entirely. In Florida, major insurers stopped issuing new homeowner policies. California followed. Wildfire risk, hurricane risk, climate exposure. The insurance industry decided American homes were becoming uninsurable. And here's the trap. Without insurance, you can't get a mortgage. No insurance means no financing. No financing means no buyers. Entire neighborhoods became effectively uninsurable, pushing their real market value towards zero. Who would buy a house that could burn or flood tomorrow with no protection? Property taxes kept rising. Maintenance costs climbed. HOA fees increased. The total cost of owning a home became a weight fewer people could carry. Yet sellers refused to lower prices. They were locked into low-rate mortgages from the pandemic years. 3% loans they could never replace. Selling meant buying again at today's rates, so they stayed put even when life demanded movement. The math trapped them. Analysts call this the lock-in effect. Millions of homes frozen in place, sellers unable to sell, buyers unable to buy. A perfect stalemate. But markets don't care about stalemates. Life keeps moving. Divorces happen, job losses happen, death happens, and eventually, forced sales arrive. Inventory began stacking up behind the dam. When that dam breaks, when sellers are forced into the market all at once, price discovery becomes brutal. The impossible math turns into lived reality. And almost no one is prepared for what comes next. 3 months ago, a glass and steel skyscraper in downtown San Francisco went to auction. 40 floors tall. 5 years earlier, it had sold for $110 million. At auction, it cleared for $11 million, a 90% loss in half a decade. That wasn't an anomaly, it was a signal. The canary in the coal mine. Across major American cities, commercial real estate was collapsing in plain sight, while most people had no idea how deeply it would affect their own homes. Walk through Midtown Manhattan on a weekday afternoon. The streets still look alive, but lift your eyes to the office towers. Floor after floor sits dark. Empty desks, silent conference rooms, abandoned cubicles. The pandemic didn't just pause office culture, it rewired it. Companies learned their employees could work remotely. Productivity held, profits held. When leases expired, firms didn't renew, they downsized, they consolidated. Many went fully remote. Office occupancy rates collapsed. Buildings that were 95% full before now sit nearly half empty. And when rent checks stop, the debt doesn't. Commercial mortgages are massive. One tower can carry loans of $50, $100, $200 million. Those loans sit on bank balance sheets, not the giants, the regional banks, community banks. The same institutions that financed the office boom are now holding assets bleeding value. This is where the danger concentrates. These banks don't just hold commercial loans, they also hold residential mortgages. The same bank exposed to an empty tower is lending to suburban homeowners. When the commercial side starts failing, banks panic. They run the numbers, they see the losses coming, and they react the only way they can. They tighten credit everywhere. Suddenly, getting a residential mortgage becomes nearly impossible. A borrower with a 750 credit score, 20% down, stable income, gets denied. Not because the borrower is risky, because the bank is terrified. They know something most homeowners don't. If residential prices fall even 10%, millions of mortgages slip underwater. Owners owe more than their homes are worth. Collateral vanishes. So banks stop lending to protect themselves. That triggers a vicious loop. Fewer loans mean fewer buyers. Fewer buyers mean lower prices. Lower prices create more underwater mortgages. More defaults follow. Losses deepen. Credit tightens further. The spiral feeds itself. And it doesn't stop on its own. A new pattern began surfacing in the data. Strategic defaults. This is when homeowners can afford the mortgage payment, but choose not to pay. Not out of desperation, but calculation. Someone buys a house in 2022 for $500,000. That same house is now worth $400,000. Every payment they make is money thrown into a hole. The math no longer rewards loyalty. So the most financially literate homeowners stop paying. They walk away. This happened in 2008. It's happening again. Only this time the protections are gone. Pandemic foreclosure moratoriums have expired. Courts are open. Paperwork is moving. Banks are processing 3 years of delayed damage all at once. The wave isn't coming slowly. It's hitting everywhere at the same time. And while homeowners struggle, insurers are pulling back even further. They aren't just abandoning residential coverage. They're exiting commercial policies too. An office building in Miami can't get hurricane insurance. A shopping center in California can't get wildfire coverage. No insurance means no financing. No financing means no buyers. Values collapse towards zero. Commercial real estate didn't just weaken, it became the accelerator. Analysts mapped the correlation clearly. Cities with the highest office vacancy rates showed the steepest residential price declines. When office workers disappear, the surrounding economy dies with them. Cafes close, dry cleaners shut down, lunch spots vanish, downtowns hollow out. Ghost districts drag property values down in every direction. What looked like a separate crisis revealed itself as a single system unraveling. The contagion spread outward, from office towers to suburban homes, from banks to borrowers. A $90 million loss on one office building seemed irrelevant until the bank holding that loan stopped approving mortgages in your neighborhood. The towers were falling, and most people were still looking up, unaware the debris was already moving toward them. In a quiet suburb outside Phoenix, a real estate agent stared at her screen in disbelief. She'd been in the business 17 years. She had seen booms and busts, but never this. Her database showed over 200 homes where owners desperately wanted to sell. Divorces, job changes, medical emergencies, estates needing liquidity. But every seller was trapped, locked into 3% mortgages they could never replace. Selling meant doubling their payment. So they stayed, even as staying destroyed their lives. Across the country, that agent's experience wasn't unique. A hidden phenomenon was spreading. Analysts call it shadow inventory. Homes that should be on the market but aren't. Sellers who want to sell but can't justify the math. Official narratives claimed supply was low, pointing to tight listings as proof of market strength. But those working on the ground knew better. Supply wasn't low because demand was strong. Supply was low because sellers were paralyzed. And paralysis never lasts forever. Life has a way of forcing decisions. Marriages collapse. Companies downsize. Health crises arrive without warning. An aging parent passes away and an estate needs cash, not interest rates. Each event pushes another seller toward the edge. The dam was filling. Pressure was building. Economists began modeling what happens when it breaks. The projections were brutal. Even a modest rise in unemployment triggers forced selling. When recession hits fully, sellers won't have a choice. The shadow inventory floods the market all at once. Overnight, scarcity becomes oversupply. Prices don't drift downward. They gap lower. But another wave was forming from a completely different direction. Short-term rentals. The Airbnb boom. From 2020 to 2022, ordinary people became leveraged landlords. They watched videos about passive income, attended weekend seminars, borrowed aggressively. A teacher in Nashville bought 3 properties with minimal down payments. An engineer in Austin tapped his primary home to buy 5 short-term rentals. The spreadsheet promised perfection. Reality didn't. By the end of 2024, entire neighborhoods were saturated with short-term rentals. Travelers had endless options. Prices were slashed to compete. Occupancy fell from 80% to 40%. Revenue dried up, but the mortgages didn't. Owners began bleeding cash. $500 a month. Then $1,000. Then $2,000. Savings evaporated just to keep properties afloat. The question became simple. How long can someone bleed before they collapse? The data answered it. Listings marked motivated seller tripled. Foreclosure notices on short-term rentals surged. And it wasn't just amateurs. Superhosts with 10, 20, 50 properties were leveraged to the breaking point. One missed month triggered margin calls. Margin calls forced liquidation. Liquidation crushed neighborhood comparables. The dominoes began to fall. Fully furnished units flooded the market. Beds, sofas, kitchens, desperation included. Price discovery became merciless. There was one more trap most homeowners never saw coming. The HELOC bomb. During the years of free money, banks handed out home equity lines of credit like candy. Millions of Americans accepted. As home values climbed month after month, houses were treated like ATMs. $80,000 for a boat in Tampa, $60,000 for a kitchen remodel and a European vacation in Portland, $150,000 pulled out in Dallas to chase crypto. Rates were low, payments were manageable. It all felt harmless. Then rates reset. Variable HELOC rates jumped from 3% to 6%, then 7%, then 9%. A line of credit that cost $300 a month suddenly cost $900. Payments tripled overnight, and the cruelty of reality set in. The boat lost half its value. The remodel added nothing to resale price. The crypto evaporated. Home equity was spent on depreciating toys and vanished experiences. Now households were trapped under two debts, a primary mortgage and a HELOC, both underwater. Bankruptcy attorneys began getting busy. When you owe $500,000 on a mortgage and another $100,000 on a HELOC, and the house is only worth $500,000, walking away becomes rational. Filings rose nearly 40% year over year, but visible bankruptcies are only the front edge of the wave. Most people exhaust every option before filing, which means the real surge is still offshore, building pressure beneath the surface. Home builders saw it coming early. New developments collapsed almost 50%. Builders couldn't move homes even with massive incentives. Free upgrades, rate buy-downs, closing cost coverage, appliance packages. Nothing worked. The cancellation rate told the truth. 1 in 5 signed contracts were abandoned. Buyers toured model homes, got excited, signed paperwork, then went home, ran the numbers, and realized the mistake. They walked away, forfeiting deposits, leaving unfinished neighborhoods behind. When construction stops, the entire economy feels it. Housing represents roughly 15% of gross domestic product. Lumber mills slow. Appliance factories cut shifts. Plumbers and electricians lose work. The domino effect spreads across sectors. Shadow inventory was real. Forced sellers were forming, and the market had no idea how it would absorb what was coming next. On a cold December morning, an unusual transaction appeared in the property records of Columbus, Ohio. A single entity acquired 47 homes in one day. Not apartments, not a complex. 47 separate single-family houses spread across middle-class neighborhoods. The buyer wasn't a family. It wasn't even a person. It was a subsidiary of an investment fund, ultimately backed by BlackRock. And this wasn't rare anymore. It was becoming routine. While ordinary Americans panicked about losing their homes, Wall Street was positioning for the largest wealth transfer in modern history. Institutional investors had been preparing quietly. War chests were raised. Billions sat idle inside distressed asset funds waiting. They weren't betting on recovery. They were betting on collapse. Their strategy wasn't to flip homes for quick profit. It was to own the supply of shelter itself and rent it back to the people who used to own it. The playbook was written after 2008. Families lost homes. Institutions bought entire subdivisions at pennies on the dollar. A generation of potential homeowners became permanent renters. This time, the scale was different. Analysts reviewing fund documents noticed chilling language. These weren't described as real estate investments. They were labeled essential asset strategies, monopolization plays. The goal wasn't participation in the housing market. It was control. When you control the supply of something people need to survive, you control the price, the terms, and ultimately their lives. Medieval lords owned the land. Peasants paid rent. The modern version wears a suit and calls itself a real estate investment trust. Demographics made the strategy even more lethal. Baby boomers, the largest generation in American history, were retiring. Their plan was simple: work for 40 years, pay off the house, sell it in their 70s, use the equity to fund retirement, healthcare, assisted living. The house was their savings account. But the plan required a buyer, someone younger with enough income to pay the price. That buyer no longer exists. Millennials are drowning in student debt. Generation Z struggles to afford rent. Wages never kept pace with asset inflation. Savings rates hover near zero. They cannot buy what boomers need to sell at those prices. This created a deadlock. Older generations holding assets they can't liquidate. Younger generations needing shelter they can't afford. Something has to break, and Wall Street knows exactly what it will be. When medical emergencies arrive, math stops being theoretical. Long-term care, assisted living, hospital bills. These costs don't wait for better market conditions. As baby boomers begin facing health crises, liquidation becomes mandatory, not optional. Homes must be sold regardless of price. And when that moment comes, the only buyers with immediate liquidity will be institutions. They will offer 60 cents on the dollar, then 50, then 40. The seller won't negotiate. They can't. Another property quietly shifts from individual ownership into corporate control.
Local governments are unintentionally accelerating the process. Cities and counties depend on property tax revenue to function. Schools, police, fire departments, infrastructure, pensions, all funded by assessed values. When home prices fall, tax revenue collapses, but government spending never shrinks. Obligations remain fixed, debt payments continue, pension promises stay intact.
Faced with the gap, municipalities raise tax rates. Homeowners pay higher taxes on homes worth less. The squeeze tightens. A house bought for $400,000 now worth $300,000 is taxed as if it's worth $450,000. The bill rises while the asset decays. For families already stretched thin, this becomes the final straw. They sell at a loss just to stop the bleeding.
And once again, institutional buyers are waiting with cash offers. No inspections, no contingencies. Speed matters more than price. Control matters more than margin. This isn't just happening in one country. The global backdrop makes it unavoidable. China's real estate market already collapsed. Evergrande defaulted on hundreds of billions in debt. Entire cities of empty towers stand as monuments to excess. Canada sits on a housing bubble detached from incomes. Australia followed the same path. The United Kingdom saw home ownership rates among 40-year-olds sink to historic lows. This wasn't an American problem. It was the end of the zero-rate era. As interest rates normalized worldwide, bubbles burst everywhere at once. A pattern emerged. Individual owners forced to sell. Institutional capital ready to buy. Societies built around ownership began converting into rental economies in real time, and the speed of that conversion shocked even seasoned analysts. What remains is the final compression of the system. Community banks, heavily exposed to local real estate, begin to fail quietly. Not too big to fail, but too small to survive. As property values drop, their capital ratios evaporate. Regulations force them to stop lending. Credit freezes. Small businesses lose access to loans. Expansion halts. Payrolls shrink. Layoffs spread. Main Street weakens. As incomes fall, mortgage stress rises. More homes hit the market as distressed sales. Prices fall further. The cycle feeds itself. Foreclosure auctions return, not slowly, but all at once.
Courthouses fill again, not with families hoping to buy, but with institutional bidders armed with algorithms, preset budgets, and instant cash. They don't negotiate. They don't hesitate. They absorb inventory at scale. Families cannot compete.